Hi, this is Randy Finney with Right Side of the Chart. This is an early session update for Tuesday, October 3rd, 2023. It's 11:06 a.m. Eastern Times. I'm starting the video, so we're about an hour and a half into the trading day. And just wanted to get one out there and show you a few things I was looking at. I was actually working on drafting a post this morning, and I was going to label it "Uh-Oh Canada," kind of a whole play on their "Oh Canada" song. And I'll get to that one second. Canadian banks have just taken out their bear market lows, and that is a sector I started highlighting a couple months back, right around when the market was topping, showing you just the bearish setups, and I'll go over that. So what I'm going to do in this video is just going to reiterate, my current positioning and outlook for the market, and then highlight again, not everything, because there's a lot. Yesterday I went through my things to watch list. Today I'll just kind of show you the important things and get this video because there's so much. There's a lot kind of intertwined, and again, I won't go over each and everything I'm watching. I've done that quite a bit lately, but I want to look at the banks, the tech stocks, and the market, and also let you know, we've seen outright crashes recently in certain, not so much key sectors, but sectors that do matter. For example, gold and silver, I would refer to what happened the last few days as just an outright crash, and it was unusual, and I've seen that in the past. I've been trading long enough. I'm not going to say I've seen it all. There's always something new, but I've seen a lot. Utility stocks, I highlighted those two recently, and they're, things like that tend to happen in a bear market, not in a bull market. So, if I'm right, and then again, the big picture that we just completed a bear market rally, most likely, and with the July highs and the NASDAQ 100. And, we're going to go see, the market itself, the U.S. market's going to take out the previous lows and head much lower. Then there's a lot of downside. And, some point we're going to hit that, what I call point of recognition, where it kind of becomes clear to the masses. So just in a nutshell, everything that I've kind of warned about for months now, back when Treasury yields were off their highs, and by most, just about, again, I'm just kind of generalizing from what I've read, but the vast consensus was buy bonds, rates are going to only go down from here. We've seen the highs. They went from hard landing, again, the consensus, including the Fed and most of the big banks, from hard landing to soft landing to no landing. That was the last debate just up to a couple months ago. And so things, sentiment can change on a dime in the market. All it takes is some bearish price action in the equity markets, or again, those other things we're watching, bonds and everything else. It's all coming to fruition. The interest rates are just relentlessly moving higher, making new multi-year highs, multi-decade highs. And let me get to just summarize this chart, and then an important point I want to bring up. I think it's probably specific with one member, but I need to address things like this, and that is, all right, so recently I had been bearish in swing mode going down, and then I pivoted just, what was it, last week, to get bullish and long, and then hit that first target short, and then I've been active trading and posting active trades, and then just yesterday posting that I reversed back to short, and I think I made it clear. I'm just, for now, that's it. I'm focusing back to the initial and still swing targets I've had on the daily chart. This was just a game recently. Covering shorts and going long was a game of bounce. I had, as you know, if you're catching up, I had 3 additional targets, which I effectively eliminated yesterday, or 2 additional targets. This gap right here, which we hit, good for a reversal, game to bounce, and then heading into yesterday, I had us going back up here. That's where I pulled the 180. And this is important because there was a comment on the homepage that's under this one, which was yesterday's video, where someone says, it sounds like a little frustration, but I want to address this. Frustration about It takes 40 minutes to get your post. Why are you even bothering showing, trades that are good for a 1% bounce? And again, I've made it clear active trading is typically not what it's about, but I've had some feedback lately, and folks that trade futures like me, one in particular said that, and it's true. If you're trading even one contract NQ, but sometimes you trade a dozen, everyone has a different number. That's kind of irrelevant, but futures are inherently leveraged up pretty good. And, if you're an active trader, and that's where a bulk of my profits come from every year, is just gaming the little micro squiggles, getting 1, 2, 3% here or there, reversing short, and it adds up. So again, if you're an active trader, I don't need to tell you that. If you're not, you're not going to become a successful active trader overnight if you're new to trading investing. My recommendation, if you will, is learn the ropes. Study technical analysis, chart patterns, everything that's what the site's about. I share what I've learned in the easy and hard way. A lot of it's been the hard, expensive way over the years, or really decades. I've been doing this. So recognize where your wheelhouse, what's in your wheelhouse, what's not, and don't try to be what you're not. But it is the same premise. Really trading, as investing using technical analysis on the long-term daily and weekly charts, as it is gaming little micro squiggles on the intraday, 1 minute, 5 minute, 15-minute charts. You just have to be a lot quicker. And, why the reason I do these long-winded videos is I get the levels and, not just the price levels, but all the things to watch out ahead of time. So, it's a whole teach a man to fish kind of thing. So you can identify and have the kind of a plan mapped out. It's not a follow me site. I've always said that. So I think that might have been the frustration here in one of these comments, where, hey, this, took 40 minutes to get this. And my answer was this. This is before I did the video, and that's where the reply was under here. I got a static chart out. That takes me as quick as it is to screenshot a chart, and then compose my notes, and then I always put, if I do a previous, the next one's down there. So that was it. So that came out, and I just want to say this. In my reply, I use a service called MailChimp. You've probably seen it at the bottom of the emails from right side of the chart. It is the premier service out there for bulk email things. When you're sending out a lot of emails at once, you have to use a service like that, or they get flagged by spam through the other providers. But here's where my answers, or what I'm getting at. I get them within less than a minute. I have them copied to 2 different email addresses just to make sure my posts are going through. There's no problem with the system. And I receive them typically well under a minute, sometimes within 30 seconds of publishing the post. Posts are always timestamped down below. So what I would recommend to do is take a look at the timestamp on the post. And if you're not getting those within a minute or so, I would first start with checking your mail program. A lot of people may not realize, if you're using a service like Microsoft Outlook, especially the PC-based version. I remember years back, I don't know where it is now, I always go in when I install a new version, the latest I'm running now. They have settings. The default setting is like check every 30 minutes. It'll check, let's say your email address is through Gmail, but you're using Microsoft Outlook on your home computer. Those emails we send out go right away to your Gmail address account, but your PC may not check. The default is usually on Outlook, when you open the program up, it'll send and receive anything, and then it'll check periodically, so it's not using a lot of resources. You have to go in there and set it to check every minute, 1 minute or so. That is a setting. Phones have the same thing. Some email programs, when you go into your phone, iPhone, Android, you need to tell it to constantly check email and give you a push notification for new emails. Otherwise, the default might be to check periodically. Okay, so that's out of the way now. And at the end of the day, if anyone's having problems with that, please check your local settings, and then you can talk to me, and I can just tell you that MailChimp sends them out. If I'm getting them, they're going out to everyone. They're batching them, sending out right away. So you might want to talk to your email provider, such as Comcast, Gmail, whoever you're using. All right, sorry to digress, but it's important in a fast-moving market, because if I see something today, tomorrow, next week that especially if you're trading the indexes right now, which to me are the easy trade. I'm going to go over this video, and I'm going to give you there are just so many individual stock setups. And guys, please, if you want them, I'll continue to post those, and I have been posting a lot of those different sectors, individual stocks within those sectors. But I've gone over the financial sector, started putting that as one of the yellow flags a couple months back, and it's been playing out. And you could be shorting the most bearish looking charts of the banks, whether it's the regionals, the big banks, or the non-bank financials such as MasterCard, Visa. I mean, literally, I've given dozens. Or you can keep it simple and just short XLF, the financial sector ETF, or even in this case the SPY if you want, because it's got a pretty decent weighting of the financials. All right, let me go to. Let's dive into the charts here. All right, so that's it. So QQQ, so far so good. Not time to get up and party yet, but again, if I change my if anything convinces me to change my mindset, I'll do so. But to me, I added this morning. I woke up, sat down at my desk where everything is. I'm looking at yields continuing to rise, oil continuing to hold up, and just no abatement in those two biggest things. Those are probably two of the biggest red flags now. I would call them. Treasury is certainly a red flag, and exactly what I said months ago. Nobody was talking about it. I said, you wait and see the treasuries break out the new highs. If and when they do, and it's quite possible, that's what you're going to hear, and that's what you're hearing now when if you get push notifications from Barron's, the Journal, or even if free news, Yahoo. It's all about these unrelenting treasury yields continuing to go up. All right, so that's that, and again, these are just initial targets, but I suspect if these start to get hit, everything I've gone over, you got the 200 days, it's quite a bit of support here, but I think it could be a relatively quick swoon down. And the bigger picture is if that happens, we're no longer going to have those daily divergences. SPY, you already don't have it right there. And I turn my focus back to the weekly charts at that point in time. It's taken a while for my lines to populate here. Sometimes that happens during the video. It's something to do with the recording software. Let me pause it. Well, there it is. Okay, so these are all longer term targets, long term. And from the top here, I saw this bear market coming back here. I laid out these are all targets. I just moved it. It's going to tell me I modified it now, updated today because I dragged it. But I created that back in November, or that one. Oh no, there it is. March 8th, 2022. Really focused on the Qs, and there's the QQQ. These are all long term targets that still. Haven't been hit. This blue trend line, and then this level down here, T4 235-ish, and I still think we'll go down to that, or I think there's a good chance. But again, I'm not right now. I'm still looking for that longer term. But you know me, I'm gonna game. If I see a reason to cover and or reverse to long. And again, that could happen today. Right now, let me just say this, we're at support. Remember, I had two red lines on the daily chart of QQQ that were the most significant levels. The uptrend line, we had a lot of smaller ones. Minor trend line break there, sell signal 1. Secondary trend line, sell signal 2. Tertiary trend line there. And then that primary trend line. But you also had this level. So we're back to that. And this needs to go to really get the party started. And now we have a reaction low. Before I was focusing on that big August 18th low. We undercut it slightly, but recovered it. And remember, got bullish there, kind of anticipating that hook. And so far that was and still remains right now what we call bear trap, false breakdown, whipsaw. And it also, on many stocks like Apple and the likes put in those divergent lows. So here's Apple. Market's not going to go that much lower without Apple coming down with it. It still has the same bullish divergences, and it's still holding the 200-day. So I just want to be clear. This market can break either way. And again, if you consider that wishy-washy analysis, you're in the wrong place, because I am not going to get married to any one bias or view or position. If the charts convince me to. And believe me, I'm going against a lot of things that normally drive the decisions in my trading, such as market-leading stocks, especially Apple here, Microsoft, positive divergence on the RSI at that new low, the false breakdown, the whipsaw. However, right now, like I said, I'm suspecting because of all these red flags, unless there's a a sudden and pretty convincing abatement of that, meaning Treasury yields start to come down pretty good without it being due to a flight to safety from institutions because the market's crashing. So there's still a case to be made that we may go up and maybe even see that a marginal new and divergent high that I've been talking about as an alternative scenario for a while. Here's Alphabet, bigger picture, big wedge breakdown, kickback rally right into resistance there. And so, we start breaking these pretty much at this point. I don't think we should take out the recent highs from just a couple days ago. So I'll share my thoughts. If I had no position at all, I made it clear yesterday going back short. But if I wasn't, I think I can I know I can make a good case right now to short here. On the markets, you get the most juiced usually in QQQ or IWM or the futures thereof, if you want to trade NQ and RTY. But you have a lot of stuff at resistance, and again, you can always short with a stop, relatively tight stop. They take you out, no big deal. If it's just a little whipsaw like that and then back down. But watch these recent lows right now because we already had that one little whipsaw. And so the way I look at it, the market has no business now going back down and taking out those August 18th lows again. If it does, because we already had the whipsaw. Usually what you see, from my experience, when you have a whipsaw move like that, aka bear trap, it's usually a pretty powerful reversal because the shorts who jumped in and shorted the August 18th low break, they start getting squeezed out, and the bulls are merciless, and 99.9% of the time there are a lot more bulls, aka buyers, out in the stock market than there are sellers. But that's what makes corrections pretty powerful when those dynamics, the supply-demand dynamics change and you have more sellers. That's why I love shorting. Stocks tend to fall a lot faster than they rise. So you can go back at any point in time, look at previous bear markets and big corrections, and you'll see in a matter of days or weeks, months, and sometimes even years of gains are wiped out on the downside. But you got to be quick, and you got to pivot and recognize when you're wrong, and that's it. So okay, on to some of the things I'm watching here, and let's start out with the let's do just a quick check on the Treasury yields. This is the 10-year, and here's my clean board. There's the breakout, and so far we just continue to rise, and so it's a breakout. Take it on face value. Ultimately, I do suspect the breakout will probably fail. Like I said, it could be one of two things. If it fails just on natural market forces, and the stock market's holding up, and I'm not seeing a lot of red or yellow flags, then that would be a bullish scenario for the market to see yields coming back down. But the other scenario is it coincides with a strong sell-off, maybe even a crash in the equity markets, and then you see yields coming down because big institutions are flocking and buying Treasury bonds, which will is a flight to safety. So we'll watch that. Again, something to watch, but right now, just can't make a case to be, in my opinion, bullish. This is a very bearish development for the stock market and the economy. Crude oil, I'm still short that one. I think we're likely blow off top, but or put in a top with more downside to come. But it's really, it's relatively hanging in there. It's not, it hasn't given back a lot of the gains. And call it a hedge too, if you will, to my shorts right now, indirect hedge. Because if crude continues to go up, that's bad for the stock market and the economy, and so therefore that should help shorts. So those are the two of the biggest ones I'm watching. And again, the damage in large part, even if crude starts to fall now or continues to fall, so it's already turned, I think the damage is largely done. I mean, look where we're at. You just look where USO is, relative to where we were back. Here's where it was in October when the markets bottomed. Here, we'll do it a daily chart and then come up here from October 15th. So right here, mid-October is when the stock market bottomed. And so we're still above there. And so in other words, we're still at high oil prices right now. Okay, so that's that. And so we can come down, and again, a lot of the damage is, I think, already been done. It'd have to be a much larger drop to really provide a tailwind to economic growth. All right, let's roll into the Canadian banks. I queue it up. I have a watch list that'll load just the banks, big banks. And so again, I was going to put a post out, and I figured, you know what, I'm going to be screenshotting so many charts. Let me just get out in video form, and so here's my Canada post. Bank of Nova Scotia. These are big Canadian banks, and what we're looking at here, you had good support here. There was the October lows. And make no mistake about it, Canada and U.S. banks are usually going to move roughly together, and so they bottomed back in October, just like the U.S. stock market did, and the U.S. banking sector checked it again, but just broke down the other day. So again, red flag, guys, right? I'm seeing more and more. So hence another reason for pivoting here. Broke down yesterday. We didn't just limp, little undercut. It's been impulsive since. This looks like, remember, I showed you utilities recently, utility sector, gold, silver, just a lot of stuff just getting pounded, going down pretty hard. Again, more typical of bear market action than bull market. A lot of folks still think the bear market ended back in October, mid-October in the stock market, and I still maintain that was likely a bear market rally. So there's Bank of Nova Scotia. I'll just hit them quick. We don't RY. I'm also going to acknowledge, by the way, that we have positive divergence. Now, that's not a buy signal. I always say divergence is far from a buy signal. It's an indication that a trend reversal is likely. A lot of these guys ended with blow-off tops. There's one right there. I highlighted a blow-off top on UBS recently. I'll get to that one next. But you can see this one has undercut. There was the previous low from October, just today taking it out. And so these momentum indicators are pointing lower. There is a potential, if they come in, step in, and do something to shore up the banks before this gets worse. I have to imagine others are watching this, not just me, but again, it just shows there's a lot going on. So, back here, right when it happened, I mentioned this one as likely a parabolic blow-off top and a short opportunity. And this is UBS, the one that they forced the bailout or acquisition of Credit Suisse when Credit Suisse failed. And so everyone thought, okay, the government's got the back of the banking system. Well, it's already down, 12%. And you might say, okay, that's fine, a little correction. Maybe so. But this, again, blow off tops, as I just showed you here a second ago with RY. Parabolic, these blow off tops typically mark lasting tops. So keep in mind there could be a lot more downside. And we'll watch this. We'll watch UPS. CM, Canadian Imperial Bank of Canada, or Canadian Imperial Bank, one of the two. There it is. Look at that. Just boom, boom, boom. There's your October lows. It was bottoming, holding support, and then boom, just broke down. So a lot of bearish stuff going on, and not just the Canadian banks, guys. The U.S. banks. These are all the ones I've watched these levels. Wells Fargo took out that uptrend line I had shown in previous videos, and it's been waterfalling pretty good since. Bank of Montreal, another Canadian bank, just punched down, took out. And again, some of these you had just a single reaction. Others, it's been boom, 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 boom. So, they all have the potential, as any breakdown does, prove to be a false breakdown. If so, if it can reverse back up, you've got bullish divergences, and this would be a, do I want to start covering my shorts, maybe even reverse, maybe go long the sector? We'll see. But the levels to watch would be a solid recovery, especially a daily close or a big green bullish engulfing candle that engulfs the previous red ones and closes back up there. And then see the PPO turn up, make a bullish crossover to keep these divergences intact. Those are all things that may say, guess what, guys, this was just a little scare, and this might be a sector to engage on the long side. As of now, it's a yellow, or even I'll call it a red flag. And tomorrow, it could be a yellow flag for the shorts, for the bearish case, if we saw a big reversal and recovery back over there. BAC, okay, so remember, it's not just the Canadian banks. Bank America has now taken out the previous lows. Its low. Remember, Bank America has been sick, as I've said recently. This is when the stock market and a lot of other things bottomed in mid-October here. But Bank America, by every metric there is, you don't have to get too creative, or you don't have to be have a PhD in technical analysis to say this is in a bear market, a downtrend. This is a poster child or textbook bear market downtrend. A security making lower lows, which it just made a new one, and lower highs. So one of the largest banks in the country and in the world. And again, just another red flag, another check mark for the bearish case. Divergence, is the Fed or some entity going to come in and save the day, or just some natural market forces, maybe. But unless that happens, these are the things I'm looking at. TD, Toronto Dominion Bank, another Canadian bank, not yet to new 52-week lows, but probably headed there. That's a preferred. Bank of America. It's a global sector for the banks. Citigroup also punching down. Okay, so you see it's not just the Canadian banks. And Citigroup hasn't yet, let me do this. Let me put the line right on the low. That's what I'm doing. I'm talking about the October low. So we're right there right now. So this is also something to watch. You see a big red candle through there. Citigroup breaks down. Again, one of the largest U.S. banks. We've got problems. Otherwise, if it's a breakdown and a reversal, or we reverse right here, we have some positive, aka bullish divergence. Those divergences get burned through. If those divergences get burned through, then lights out, and you can take a look too at the weekly. I'm just going over the daily charts. This is, I was just showing you back a couple of years, but you can go back for decades here, and this is a big level down here. This support right here, about 38 or so for Citigroup, and this has been a dead money stock really since the last financial crisis. So another one I had covered recently was, and probably one of the better looking shorts right now, whereas most of them are down at or below 52-week lows. MUFG, this is Mitsubishi Financial, so Japanese bank, just breaking down. This one didn't get the memo. And again, it's Japan, and they've done different things over there recently to stem the drop in the yen, but the Bank of Japan. But either way, from a pure technical perspective, this guy's just rolling over. Big divergences, more meat on the bone, I think, than some of the others. We all know that Washington and the Fed will there's no limit to what they will do to save the banks. We saw that back in the financial crisis. The banks all got bailed out, even though they created the mess. They all got bailed out. Nobody went to jail other than Countrywide CEO. He was kind of that was Countrywide, and was a mortgage lender. But the big banks all get saved. And so, I don't care really to short them, but to me, it's more of a tell on the economy, because if the banks aren't doing well, the economy is not going to do well. Okay, they're tightening. When they drop capital requirements, lending standards are further constricted. So you have rising rates and a problem in the banking sector. Let's not overthink it. That's no bueno for the economy. And I don't care how many are out there saying, "Oh, this economy is bulletproof, and the rising rates don't matter, and the consumer is just spending, and they're resilient, stimulus checks." It's nonsense. If these trends continue, rates stay high, or especially if they go higher, and the banks continue to have problems by looking at the charts, then there's just no way this economy is going to pull a rabbit out of its hat and continue to just chug along without either mild or severe recession, or including and not limited to a stock market crash potentially in there too. So, all right, I think you get the point. I can go over them all. There's no point in doing that. Oh, the big one, of course, JP Morgan, JPM. The golden child of the Fed and in Washington for that matter. Big support. It's flirting with it now. This one's a lot closer to 52-week highs, well off the October lows. And so, that just doesn't jive. All these other banks, and not just the Canadian banks. I showed you Bank of America and and Wells Fargo, some of these other big U.S. banks, Citibank, way down here, what's going on. And we know, again, this bank's been, they have favored nation status in the UN and all that, in politics or global politics. But in this case, you have like favored bank status for J.P. Morgan. So that's, of course, gives them a premium over the rest. But if this breaks down, I promise you're going to start seeing this in the headlines. What's going on with the banks? Regionals, we already know what happened there, and we know the Fed backstopped them, but they continue to sell down. So that's it, guys. Interest rates, crude oil prices, and now the banking sector is flashing yellow, if not red flags. And the levels to watch. Here we are at support. It's mild support, but we start to see, especially if you start to see that waterfall type sell. I'm referring to what we saw on utilities recently. This is waterfall selling. This is not. Again, this is that's what you had in the start of the bear market right there, and you had a shot across the bow. The Wall Street ignored it. They bought up the utility stocks. Again, we're telling you, hey, there's problems. Rising rates. Utilities are very rate sensitive, and you're seeing it again here. And so, okay, so I just want to impress the point that you can see that in the market. Most don't see these things. They don't always happen. They're super rare. They're super hard to call. But I've never missed one when we've had a big swoon down, like a mini crash, whatever you want to call it. I don't want to over dramatize it, but I'm talking a swift move that just doesn't let the longs out, and the short sellers, they want to get in. They're waiting for a bounce. It just never comes. That could take you down somewhere in here quick. In other words, as I've been saying now for a few weeks, I think if we hit my T2, we're probably going to have that quick swoon down, and I've shared it recently, but I'll reiterate. I probably will not be covering at least that next target and reversing like I often do, as I did on T1 recently, even on the undercut of T1, which was even a better entry. I don't plan right now to do that, because if I start seeing things break down, there's a lot of stuff that can break, and you could see it's possible to see us, just shoot right down through T5 even right there. But first things first. All right, let's watch those levels. Let's see how the banks do. Let's see if the buyers step in and help, start buying those banks up. Get the, all the Canadian and U.S. banks that have undercut or testing the previous bear market lows. If they start to rally off there, firm up the divergences. If Treasury yields fall back down, especially below the recent breakout to new highs, those are the things I'm watching, and that's when I'll either tighten up stops on the swing short positions on the index shorts, or outright reverse, cover and reverse, and I will let you know. All right, guys, this has been Randy Finney with Right Side of the Chart. If I see anything else that I left out, I'll highlight it. Otherwise, let's just see how things play out today and how we close.